Good morning, everybody. My name is Pablo Castro, and I'm excited to be here on behalf of MyFly, an organization driven by students passionate about finance and dedicated to promoting financial literacy. We are proud to have thousands of members across dozens of countries, united by our commitment to empowering the next generation. Today, we have a special guest with us, Manuel Echeverria Falla, a professional at Octogone Gestion SA. Mr. Echeverria, thank you so much for taking the time out from your busy schedule to join us. It really means a lot to us here at MyFly. We really appreciate all the support that you've been able to give us, and I know that viewers are eagerly watching and are looking forward to your insights. How are you doing, Manuel?
Thank you very much, Pablo. I'm happy to be here and happy to help and happy to speak to you.
Oh, great. All right, so we'll get it started. So for the first question I have is so you've been in the investment management field for over 3 decades. How have you seen the role of Chief Investment Officer evolve over the years? What are the biggest challenges and opportunities for a CIO in today's environment?
Well, I think things have changed a lot partly because financial markets have changed a lot too. In addition, there's been the development of a lot of investment strategies that did not exist before. Let's say when I started my career, it was 1985. I used to work for JP Morgan in the US. Just to give you an idea how things were at the time, if we wanted to buy a non-US dollar security in the US, it basically was pretty much impossible. The systems did not allow it, even though you could actually transact and maybe buy or sell dollars to buy Deutschmarks at the time, or Italian lira, or French francs, or Japanese yen, or any other currency. The systems in the bank did not really allow, or it was very difficult to book those trades. So we are now almost 40 years later, and things have evolved very, very much. The world has become very global. So that means more complications too, because one has to be thinking not only about what happens in one place or one part of the world, but you also have to be thinking of what happens everywhere else. And it's not so much that everything is related. In addition, the way that markets have been behaving, it almost creates ecosystems where investment ideas are all related to each other. And I can give more examples later on, but this is I think what's changed. So on one side, everything easier to transact. You can do many things, but more complicated because there's a lot of moving parts. And so when you're deciding on a global asset allocation, which is what many CIOs have to do from a top down, it's becoming more and more complex because it's all about one thing against the other. So yeah, very interesting times.
So like the globalization of all the investment process has in some ways it gives like CIOs wider range of opportunities, but it complicates other factors, no?
Absolutely. So let's say, for example, I'll give you an example. For example, in the US right now, the US market, there is a very high concentration in the indices, as more and more people use indices to invest. There's a very high concentration today of technology companies. Mm-hmm. So you are investing, when you invest in the S&P, for example, 500, you are investing, the top 10 companies are close to 40% of the index. So there's a high level of concentration. So in a way, you're making a bet. For every $100 you invest, you're investing 40 in a few companies that are very, I'm not going to say similar to each other, but they're great companies, but have been the ones driving the markets for the past number of years. So the more money goes into the index, the more money goes into these companies, and therefore these things become more and more expensive. and so that would be the case of, for example, the US. If you take the case of Europe as an example, they have the US has the very common name of the Mag Sevens, the seven companies that are the leaders and the tech companies. In Europe, you have the granolas, and the granolas they stand for all these different companies, but they're a lot more diverse. So you have a number of healthcare companies, pharmaceutical companies. You have some tech companies, etc. Again, similar to the case in the US, there's a high concentration of money in these companies because they have the highest market cap of most of the indices. So on one side, the actual investing process is easier because you can buy indices very easily. But in reality, if you are somebody who wants to really discriminate against too much concentration, or wants to decide if these companies are the best places to really put your money, and even because they become too expensive, then it becomes more complex. So I think the other important point is how investment managers are judged in what they do. You generate a performance, and that performance has become you're being judged on how well you perform against something else. And again, this comes back to the index and the indices in general. And as I said before, these indices have a high concentration on a few companies. So in a way, if you want to perform well and not be more diversified, then you're taking an additional risk. And that additional risk is either positive or negative. If you perform better than those indices, great. If you don't, your investors are not going to be happy with you, and that is a big problem for everybody. So yeah, those are some of the challenges.
Okay, yeah. Just like going off of what you ended, what you were talking about there, about like balancing, like as as a CIO, how do you like what is the way in which you balance like the risk and the and reward, like how much how much do you allocate to like risky investments, and like how much do you allocate to like safer maybe indexes or whatever, like
Okay,
yeah.
sure. There are two ways of kind of looking at the investment process. There's one way which is saying kind of the traditional way you make an allocation, a top-down allocation based on different asset classes, and those asset classes have inherently different risk reward characteristics, and then you allocate according to what your belief is, going always looking forward of what the markets are going to provide, the opportunities the markets are going to provide, and also you adjust that to your risk reward targets. Now, this is all very theoretical because you're assuming that many asset classes behave or will continue to behave differently or same or similarly to how they perform in the past. So in a way, think about, for example, fixed income investments. So fixed income investments, buying bonds, you think about you're buying a IOU, you're buying a note that a company has issued that will at the end of a certain maturity go to par, go to 100. So the idea is that these investments should be less volatile and therefore provide a good diversifier from the more risky investments, which could be equity investments. Now, the problem is that everything is very tied up, and in those correlations, sometimes they have, in general, fixed income and equities have negative correlations in many cases. So in cases where equity markets fall a lot, normally fixed income markets actually do well because there's a risk averse. Investors try to go for the less risky investments and they buy fixed income. Okay, I'm not going to go into that whole relationship because it could take a long time.
Yeah.
But what happens is people then look at a different way of saying, and they say, okay, I'm not going to allocate according to the more traditional way of saying asset class A, B, and C. I'm going to allocate according to purely risk reward functions. And then you look for different asset classes or different ways of managing money that provide a certain type of risk reward characteristics that are interesting. And that's another way of building portfolios. So there you try to optimize that risk reward, maximize your Sharpe ratio, minimize your volatility overall, and it's another way of doing it. Now, there is no nothing. There is no one way to do this exercise, but there are different ways to be able to allocate money that way. So maybe some of these concepts are too general at this point, but I can go into more detail if needed. So.
Mm-hmm. All right, great. No, that's really, really insightful and really, and like, I think I've talked about this with you, but just so our viewers know, like different different like clients want different types of portfolios, no? So you adapt each, like depending on how much risk reward, like what you were talking about, each client wants, you make a different portfolio for them, no?
Absolutely. I mean, the problem is that humans are not. They are. I mean, we're all very interested in trying to make as much money as possible when the opportunities are there, but are extremely concerned when you start losing money. So if you were to choose one of the two things, if somebody offers you, you can make a lot of money, but you can lose a lot of money at the same time,
Yeah.
or you can, or somebody says, look, you can make some money, but you're going to lose very little.
Mm-hmm.
There's appetite for two things. So, fundamentally, you have people that want to, they have a professional life, they have savings. In some cases, they want to be able to generate certain returns, but not lose money because they want to kind of stay rich as opposed to get rich on their investments. And then you have other people that have maybe in a different dynamic, and they want these investments to generate a lot. So those are willing to take more risk.
Mm-hmm.
And in risk, the risk at the end is measured on the potential drawdown. Drawdown is simply, a loss. So peak to trough is how you measure that. If somebody is able to, for example, accept to make
Loss of
30% plus,
yeah,
but also lose 30% in a worse situation, then that is, that is a risk reward type of function that would be maybe acceptable for somebody with more risk. The problem is that they say that, but until they actually go through the loss and that drawdown, they don't really understand that. So, as an example, the past number of years have been quite interesting. So, if you take, for example, the case of 2022, 2022 was a year where you had a very, very negative return on equity markets after having had very strong returns in 2020 and 2021, even 2019, even though 2020 was very special. So the problem is that investors change their psychology. So if you're an investor and you actually did very well in 2019, did relatively well in 2020, did well in 2021, your appetite to take more risk might have increased because you only had the experience of making money. You hadn't seen what it was to actually lose money.
Yeah. And so then you're 2022 comes up and you're like, oh, I've been
you've allocated
past 2 years, I can
and probably you're over allocated to the risky assets
yeah,
because those assets have actually generated better returns. So then 2022 arrives, and then, for example, all these technology stocks were down 50-60%. And when you are down 50-60%, you realize that mathematically, to recuperate that, you need to be 100% up just to claw that money back. So that whole exercise, I think, was very interesting because many investors who thought were more aggressive or wanting to take more risk, backed out in 2022. And of course, the problem is that this is all very psychological. It's not anymore. It's fear and greed. And then when you have fear and you see something falling, many clients or many investors say, sell everything. I cannot take it anymore. And what normally happens is they become from being maybe overly aggressive to becoming overly conservative. And then when markets take off again, they miss out.
So it's like a vicious cycle, no?
Absolutely. So this is why it's important to spend a lot of time with investors to understand really what their tolerance to lose money. That at the end of the day, that's the key. And the tolerance to lose money, and then desire to actually participate if things go well. But know that's going to be, there's a limit to that. You cannot make everything. So this is how you then develop an asset allocation that kind of fits that. So, the most traditional ones are the 60-40 models, 60% in equities, 40% in bonds. There are some that are maybe more conservative, where it's maybe 60% in fixed income or bonds, 40% in equities, etc. And that's how you derive to these different models that you can actually then backtest going backward and provide investors an idea of how these models would have worked in different market cycles. But again, 2022, bonds lost 15% and more in some cases, and equities lost 20 more percent. So that diversification did not work that year. So again, models are also as good as the past, but you never can really anticipate everything. So yes, it's a complicated process.
So finance is becoming increasingly digitized with AI and machine learning, making their mark on investment strategies. How do you see these technologies influencing asset management, and what advice would you give the next generation of financiers about how their role will change as a result?
Look, I think, finance and markets and economics, they're basically, for example, let's take markets. Markets create data points, right? So every day, every minute, second, whatever, there is a security or a stock or an equity or a fixed income that has a price. There's a price, and that price creates a data point. So that huge amount of data can be then used with all sorts of models. It can be AI models. It can be, statistical models. There's many, many models. And this is not something new. This has existed. Maybe with AI, things are going to evolve. And those models will look back in history and say, okay, this security or this asset class or this index behaved a certain way at a certain time. And I guess you could, and you can, and this is what certain models do, is they go back in history and they analyze what certain asset classes did in certain periods of time, where there's some circumstances. And with all the data points that we have, we can then try to analyze and try to predict the future. All these models are based on predicting the future. That is the base of everything, because AI can produce lots of it's not going to be able to predict the future. It will provide you with inputs. So as an example, let's take something that AI is able to do now. So you have data points on things like equities and everything I mentioned, foreign exchange and all these different things, commodities. But there are things that you cannot analyze. So for example, let's take news flow. So news flow provides also data points that you could analyze and say, okay, when certain things happen in the news flow were like this, the reaction was that markets did this and that. So you could start adding more and more data points to these and inputs. And again, the holy grail at the end is to try to, project what markets will do in the future. Now, I think AI will generate eventually very powerful tools that could, help people allocate the money in a way which is, as I said, trying to optimize everything and looking always at the past. But what these models cannot do is obviously predict the future. And so you assume that history will repeat itself. So let's say, for example, when a politician says this and this and this, markets react this and this way. So you see that in the past and you say, well, let's predict that. And when you hear somebody say this, then you should expect that. Now you have, for example, at the micro level, one of the things that that many people are looking at is like there's the guidance. You know, when a CEO of a company or a COO of a company, on a quarterly basis announces the results of companies, they provide something called guidance. Guidance means what they expect in the next quarter these companies will do. Well, now they're analyzing the tone of voice the CEO or CEO is using compared to every tone of voice that he's used in the past, because all these are recorded. So
they're trying to like use that to maybe like
predict
like inside information or
not at all. It's not inside information. This is
like,
very, very public. This is
but
very
like
public.
Like try to like
no, they're just saying,
see what
look,
they're
okay,
thinking, no? Or
absolutely no. They think, well, in the past, every time this CEO had used this tone of voice is because he was he was more negative about the future than when he used this other tone of voice. And again, these are inputs to try to predict what could happen. And we can go to very detailed other information like that, and etc. So at the end, then you have analysts too that are, this is public information. So analysts that cover these companies, they might react in a certain way and they might say this or that. And then you go back and say, well, how do they react in the past? So at the end of the day, we're talking of data, lots of data. So AI and a lot of the new tools provide, and a lot of new computer power provide all these the capacity to actually analyze that data and provide some sort of insight that you could use to, again, predict the future. Now, will it be always successful? Probably not. The more people use the same data, the more people use the same models, the least probable that you'll be successful. So, lots of potential new things coming up, but the more, but I don't think at the end there is a lot of common sense about how to invest and how to position oneself in the future, and I think that will always be one of the principles of investing, because more data produces at the end more competition for that same data. So because at the end of the day, the competitive advantage you might have of being able to process data is not a real competitive advantage if somebody has more computer power or just a better model. So that's why this is how it is.
And like maybe I think so you have like quant firms that like use like, would it still be called AI, or it'd be like models to like predict like short-term like trades and everything, but more for
I mean there's this you call these quantitative strategies or quantitative investments, or people that use all sorts of models to try to make investments in a way that hopefully they can make again risk adjusted returns that are quite interesting. And many of them are trying to limit the they're trying to basically, maybe this language is a little complicated, but basically they're trying to isolate the idiosyncratic risk from the actual market risk. The market risk is this idea that markets go up or down, and that is what you call the beta of the market. That is very difficult to predict. However, if one can isolate those risks or those opportunities that are very related to specific stocks or specific situations, and not take that market risk, but just take that idiosyncratic risk, which hopefully will make money for you, is what many of these models are trying to do. So that is I think something that is mainstream or becoming more mainstream. But it doesn't guarantee anything. I think we're going to see more and more use of these models to try to, as computer power and AI systems provide more and more input. So, but that's really what many of these are trying to do, and they're becoming mainstream now.
Mm-hmm. Okay, so going a bit off like the tech kind of like new developments. So like cryptocurrency has generated a lot of debate. Someone with a strong background in traditional finance, where do you see the future of cryptocurrency in global markets? Do you see it as an opportunity or as a potential risk for investors?
I mean, risk, reward, always think of that. So I don't see things being cryptocurrencies creating a risk. They create an opportunity. Now, the question is more, will they become a mainstream way of investing? And frankly, I have a very, not a hard time understanding, because I do understand, but very hard time deciding if this will be the case. And the reason is simple, is that I think you and I have discussed this in the past.
Yeah.
Cryptocurrencies are were invented by humans as a method, as around a blockchain. And the whole concept before was, I create a specific blockchain that hopefully more and more people will use one day. But to have an economic incentive to use that blockchain, I developed an algorithm or a protocol that determines that how these cryptocurrencies are going to work. So let's say in the case of Bitcoin was a blockchain originally, and the unique thing about Bitcoin was a protocol that everybody who used the blockchain and agreed to use it as a had the knowledge that there was going to be 21 million Bitcoins mined, and therefore that would be a finite number. So then the investment community decided that it wasn't the use of the blockchain itself which was interesting, but the fact that there was a finite number of Bitcoins in circulation. And that scarcity factor pushed many investors to look at that. And to a certain extent, I believe that the Bitcoin phenomenon, to a certain extent, gold is a similar situation. These are, humans right now, in terms of how we invest, one of the obviously most important things is the currency we choose, right? So let's say we take the US dollar, and behind the US dollar, there is obviously a country, there's an economy. That economy has its strengths and weaknesses, etc. But there's also the debt of that country. And one of the worries of many investors now is that after the COVID situation, and the need and the fact that governments went a little bit crazy in terms of issuing a lot of debt to inject in the economy and make sure that the recovery would be okay, they basically now find themselves over indebted, and that over indebtedness, it's almost like a drug. How do you go back? How do you try to balance your books? How do you balance your finances if you're used to now spending more than you're getting? And I think the worry that many investors have, and they use blockchain or the blockchains or the different cryptocurrencies as a way to hedge themselves against that, has been this worry that this over indebtedness is going to lead us into a situation where at one point these currencies will devalue against themselves, where we could have either a very strong recession or depression, or we could have a very strong inflationary period, or whatever it is. And so I think the use of the cryptocurrencies as a refuge for where to put your money is a different thing from what it was intended to do, because these currencies were developed, or these cryptocurrencies or these blockchains were developed around a concept, a proof of concept of a blockchain.
Mm-hmm.
Now, the only thing I have a problem with, and maybe I'm not a, maybe I'm too old for this now, but I think what I think of is that the fact that there is no anybody can create a blockchain.
Yeah.
You and I could create a blockchain,
Mm-hmm.
and we create tokens, and we try to replace those tokens with people. And if enough people actually agree to use our tokens or have our tokens, and there is a protocol behind that determines that everybody feels comfortable with, there's a new cryptocurrency, and then somebody else can. So the boundaries to entry are very, very
zero.
weak.
Yeah.
And so that's one of the things that I believe is
negative.
Is missing. Yeah. So.
All right. So we only have about 6 minutes left, but I wanted to ask you, like, what advice would you offer young professionals starting their career in finance today? What skills or experiences do you think will be most valuable to them in the next decade? I think it'd be better to maybe focus more on like people in high school and people like starting college, or like things they could study, or like things they should focus on.
Sure. Look,
Yeah.
I think that I think finance is very interesting, but you have to go kind of with the building blocks. You have to understand how a company actually functions, because many of the securities we're buying, what's behind our companies. So,
Mhm.
I mean, things like accounting, you might think this is a useless thing, but accounting provides you a very basic, let's say, understanding of how a company functions. There are assets, there are liabilities, there's equity, and I think getting used to those concepts early on
Mhm.
hopefully provide you already with the knowledge of how one of the building blocks of investments starts. I think secondly, I think understanding markets, understanding the macroeconomics,
Mhm.
economics, how the world functions, is also very interesting. And I think it's a great way to prepare oneself for how markets and finance will develop.
Mhm.
Um, then I'm going to give you one advice, which is going to sound like pretty stupid, but this is same advice somebody gave me exactly in 1985,
Mhm.
was read the paper every day, understand, try to be informed. You don't have to read the paper per se. You can find yourself a publication that provides that. You don't have to, you read that online. You basically, but try to be informed, and based on being informed of what's going on and listening to a number of concepts all the time, and when you don't understand something, and you read, you just research it, try to understand what's behind it.
Yeah.
That it's like an exercise. It starts exercising your mind to think how markets work, how companies work, and then how finance will, um, how this develops, and I think that knowledge is very important.
Mhm.
So be informed. I think what I would suggest that you don't do, um, being, at least in the area that I'm involved, which is investment management, which is, as I said, trying to find ways to invest one's money for the future,
Mhm.
is be very humble,
Mhm.
because there are many things that you think you let's say, for example, as a young person, you open an account, an online account, you're given some money, and you start hunting certain companies and saying, well, this has worked for some people in the past couple of weeks, I'm going to punt two, da da da. And you make money once, you do it the second time, and you start thinking you have it, you have
Yeah. Like the
this
yeah.
knack, this thing, I have the edge, I found it. um you don't. I'm don't want to sound terrible, but you don't. And that is not a good way of investing. And normally when you have bubbles, and I think we are partly in a bubble now, um, you can catch some of these trends. And if you're disciplined, you can participate, get out, eventually wait for something else. But eventually, the markets don't behave like this. They behave irrationally, and you're going to lose money. Mm-hmm. And the key thing is just be disciplined. If you are investing, you say, well, I'm willing to risk this. If it doesn't work, I want to get out, even if I take a small loss. And again, always have objectives, theories, points of reference, and be very disciplined, and be very, very aware that markets and investing has a lot of emotional to it too.
Yeah.
When you start making money, you want to risk more. Mm-hmm. You really believe that you believe yourself, you believe your own thing. You said, oh, I have it. I can, I did the past 3 trades were great. So I think I should put more money because I'm very good at this. Mm-hmm. Be humble. There's a strong element of luck. Very important word in investment. You cannot control it. You just have to be aware that it's there. Luck can be there and can go, and it's not something you can repeat. Yeah. So just be humble. That's all.
All right. So thank you so much, Manuel, for sharing your valuable insights and experiences with us today. Your journey from your academic background to your career in finance has provided our listeners with a clear and inspiring roadmap for navigating the worlds of finance. To everybody watching, we hope today's conversation has sparked new ideas, answered some of your questions, and perhaps even ignited a deeper passion for finance. Whether you're just starting to explore that field or already have a clear vision, remember that the key is continuous learning and adaptability. And if you found today's session helpful, we encourage you to stay connected with MyFly and engage with our global community of finance enthusiasts. We'll continue to bring you discussions like this, featuring industry professionals and thought leaders to help you stay ahead in your journey. All right, Manuel, thank you so much. This conversation really, at least for me, really helped me a lot, really helped me see and think more about what we see every day in finance, and just have more insights and more knowledge about it. I'm sure it helped everybody.